We're going to start off with what I call the Bay Area data, which is San Mateo County, Santa Clara County, Alameda County, Contra Costa County, both single-family homes, condos, and townhouses in a blender. For this data, I used 2010 and through 2019 for my 10-year reference. This is the first data slide. It's the number of offers that accepted in the past 5 weeks, and I find this to be pretty telling. It's second behind the DUI that I don't have for 4 counties because I don't have active inventory for that, and nobody keep the same definition that I do, which is listings that are on the market. They don't have an underlying contract. The MLSs count pending transactions. That gives you misleading information. Unfortunately, this is the best data I have for the 4 county area. And that's because the number of buyers has a bigger impact on the marketplace and the DUI than does the number of listings available. Yes, they both impact it, but the number of listings available tends to be far more stable. So what's this telling you? It's subtracting the DUI from the 5-year median for the DUI. And in this case, it's not DUI, it's number of offers accepted. You can see we hit the peak right around the middle of March. And if you talk to people, they would have told you the middle of April was still a great time, but clearly the market was deteriorating. By the middle of May, it was deteriorating. And I think people were still saying the market was strong. I don't think most people paid attention to the market changing until about June. And you can see at about June, it looks like we were already at the bottom. Why is that time lag significant? Notice that we're no longer just at a plateau, but we're climbing back up. This looks like it's going to be a fairly short-lived slowdown. It was fairly dramatic. It was as dramatic as 9/11, which is sort of shocking to me. And there was no one particular event. But if you say it started back here early in March, I think maybe what was happening before that, we were decreasing the number of multiple offers. The real impact was probably around the end of February, which does tie into increasing interest rates probably for the first significant time in the breakout of the hostilities with Russia and Ukraine. And the other thing that I think plays into this that I haven't heard people talk about is the general public was COVID tired. Real estate is an optional event. I believe holidays became more significant this year. The more people took time off to travel. All those things combined to cause a slowdown. And now maybe people are returning to somewhat normal and we're improving. Now, clearly, we're not back up to the median because the median would be up here and we're still 1,000 units short. So we're still fairly short, but we're not 1,500 units short and the trend is clearly up. So those are all good indications. Here is the numbers for people that like it. I think it's 13 years of data on here. It's simply the raw count of the number of offers that were accepted in the past week, and the 901 is the lowest. Last week, we were actually the 9th lowest. We've gone down a little bit, but the differences we're not really talking very much. For example, 968, 967. And the reason I'm calling it the 9th is I suspect this number will go down as transactions fall. Will we catch 911? No, we won't catch 911. But if you go up to the current year, we're at 901 and we're not that far away at 926. You got to look at the numbers to some degree. This is showing you the breakdown of the 4 counties and how it makes the components up. Single family is on the left, condos and townhouses are on the right. I think the key takeaways here are coming down here to the number of offers. I like using the 5-week numbers. It gets some stability in here. There is some bounce. Santa Clara County is up 5%. Alameda County is down 4%. Those are 2 counties that are roughly the same size. Contra Costa County is down 2%. San Mateo County is up 2%. They're sort of mirror images of each other. What's that really saying? Well, with a little experience that I have looking at the data, the epicenter of the Bay Area most of the time seems to be Santa Clara County and San Mateo County. What I would say is Alameda County and Contra Costa County might still be on their way down, where Santa Clara County and San Mateo County are already improving. This is based on 5-week data, so it's pretty good. Overall, there was basically stability in the marketplace with essentially no change in the number of offers accepted. And then on closings, I like again to use the 5-week numbers. It gives you stability. There's a lot of weekly fluctuation. But what are some of the takeaways? Consumers like to pay attention to is price. But before we get to price, we look at the frequency of overbidding. We're down at 47%. Only 40% of that single family homes in Santa Clara County are getting overbid right now. The high area is Alameda County at 55%. Now and remember, to get sale price, you're 5 weeks back. We're still coming down on that plateau. So if Alameda County lags behind Santa Clara, this is still on the way down. This is probably at the plateau plateau and about ready to go back up. Sort of crossed over the bridge here with 99% is being the average sale price to list price ratio. And I should put in the 0.4 because 0.5% is normally not a big deal. But when you start looking at sale price to list price ratio, sellers are very resistant to take a significant amount of money below their asking price. And that keeps the average very close to 100%. Some of the lowest numbers I have seen are like 97.5%. And that's like in the worst marketplace we had. 0.5% does make a difference when your total range is from 100% down to 97.5%, 99.4%. And then you can see the appreciation for the last 2 years now is down fairly significantly. We're down in the high teens, low 20s, and that number was basically approaching 50%. Now, not only have we lost the appreciation that we gained in 2022, we're starting to lose some of the appreciation we gained in 2021. Now you're going to have to start pricing homes back in the 2020 timeframe. Although I think we're just about bottomed, I think what I would probably do is take 2021 pricing and take off a little bit off of that. Now we're looking at what I call blended data. This is what I used to call macro data. And I'm going to try to change over to blended data because 4 counties is clearly larger than 2 counties. And here we're looking at Santa Clara County and San Mateo County. We're also changing the reference year from 10 years to 5 years. And the 5 years that we're using are 2015 through 2019. And while we're talking about this, I am actually making significant progress on unifying this data. I started the data acquisition after I did all my data quality control checks or calculations. I actually had the data for quite a while, and now my computer is crunching away. When I say that, I did rough estimates and then a more accurate estimate. It's going to take 250 hours of my computer crunching. So I took 2 of my 3 computers. They started crunching the numbers Thursday afternoon. So hopefully finally next week we'll have consistent data for the 4 counties. But that's probably way more detail than most of you want. So now we're looking at the distribution sale price to list price ratio overall. And this is the blended data. You can see up here, the purple is the current week. So the people that are getting overbid have come down quite a bit. But if you look at the bulk of the graph is either even above 100% and below 100%, it's improved. We're basically at a plateau. We were coming down absolutely earlier this year. Then we turned around and we went up because the burnt orange line is just last week, the dark orange line, and the light orange line, I think it's 3 weeks ago. And then the gray line is 2 weeks ago. So these 4 lines right here are the last 4 weeks, and they're basically on top of one another. The burnt orange is clearly the best. Why last week was significantly better? Just a fluke. And, again, this is looking at 1 week data. 1 week data does fluctuate quite a bit, but you can clearly see this is our all-time best week up here, the red dotted line, March 26th. You can clearly see that we're a whole lot worse off than we were there. And you can see the blue dotted line is the worst week we've ever had. Now, again, it may look like we're very close to that, but my comment earlier, it gets very hard to get this line to continue to move past 100%. So even though visually and numerically you're very close to this blue dotted line, it's going to take a lot worse market conditions than we have now to get anywhere close to this blue dotted line. This is the same data set, just only 8 weeks. So you got the 4 dotted weeks up here. You can see 3 of the 4 dotted weeks are clustered. Then you got the dashed lines, which are 4 weeks in the middle, basically the month of July, and one of the dotted lines that are pretty close. And now you can see the solid lines are all pretty close together. So the last 4 weeks, basically the month of August, has been basically a plateau. Month of June, much better. Month of July, a little worse. August is the worst, but it looks like we've hit a plateau. And based on this being lagging data and the number of offers accepted is 5 weeks more recently, that's improving. So I'd expect this data will now start back up and start improving. This is a little bit interesting. The number of new listings this week is way up. And you might say, why is that? Again, you're comparing this to that 5-year normal. The reason is Labor Day moves around. Not only does Labor Day move from September the 1st to September the 7th, my base year has fluctuated up till this point. And that is basically, I take the first full week in January. This year, January 1st was on Saturday. The first week was January 1st through January 7th. Sometimes it's later, like it starts on January the 2nd and goes to January the 8th. Not only are you moving with your base year, you're also moving with your calendar years. The bottom line is this year in 2022, Labor Day is going to fall in next week's data, which I think is week number 35. This is week data 34. A lot of years, Labor Day falls in week 34. We didn't have the drop down in the number of new listings because Labor Day is still a week off. So when you compare it to normal, you had a huge increase. And that's all this is. If you look at the number of new offers, that's more stable because that will get impacted next week. You can see next week's impact way up here, and overall inventory doesn't get impacted. And so that's why you need a little history on when you're looking at data. Here's the DUI. This to me is the leading indicator. This is my 5 days per week gain, which is a changing marketplace. We were very close to that here, but you can see that the data line, the solid bold data line, is above it, and here it's clearly below. So that means it was rising less steeply than 5 days per week, and you normally increase. And that's why I said, the market's clearly changing, but it's not what I call a shift in the marketplace. A shift in the marketplace is when you're racing between a hot marketplace and a buyer's marketplace, or from a buyer's marketplace to a seller's marketplace, which we do. And then you can see here, back week 27 was the worst DUI we had. We got up to about 65 days of unsold inventory. I think it was 64 and a half, if I'm remembering. And now you're down here actually back into what's considered to be a seller's marketplace, somewhere around 38. And you can see you're right where that 5-year median is. If we reflect back on 2015 through 2019, those were good years. That's basically where we're back to now. It's sort of amazing that when you look at this graph, that isn't a huge change, but clearly the market has changed dramatically. Here you're looking at the 5-week new listings. So now we're looking at 5 weeks, so it's more stable, and the new offers. And basically, when the blue line is above the orange line, you have a slowing marketplace, and you can see the two are getting closer together. The number of new listings coming on the market is decreasing, while the number of new offers are coming up, and they're getting pretty close together. Once they get together, as you can see, they were starting in 16, 17, 18, 19, 20, and 21, we will start being off to the races again. Whether that happens or not is another question. Here's your DUI. You can see it went way up and it's coming back down. This data here is about 42 days. And I believe the reason that's higher is I've added in condos and townhouses, where I think the previous one was single family only, even though I thought it was blended data. This is looking at days on marketplace. I put this in for inclusion. I don't think it's very accurate, because when you look at this, and if you said that the median days went from something like 9 to something like 15 or 16, that really doesn't reflect the change that we went through. Or even if you take the average days and say we went from some number like 11 to some number like 25, again, that isn't so significant. If you go back up to the DUI numbers and you said you went from somewhere around 12 to some number around 65, that's way more reflective of the marketplace. DUI changes essentially with the number of offers accepted, because it's the rate of sale over current inventory, where days on market takes time for that number to increase. That's why it's a lagging indicator. Here is looking at the median price in the orange, the lowest price in the blue, and then most expensive price in the gray. And you can see all three of them have turned down. And for the most part, if you look back, you can see you're basically at 2021 pricing and getting close to 2020 pricing. Here you're much closer in the middle to 2021 pricing. You're clearly still significantly above 2020 pricing. And with that, I'm open for questions before I go into detail. The green is what I call my root URL. If you go there, you get to my YouTube archive of these channels that I try to get posted later in the day. Sometimes I have other obligations and it takes a while. You add 2022 to get to this week. You add in the letter H for handout, 2022-08-27, and you'll get today's handout. And it got posted about 10 minutes before the hour. And lastly, any specific episode. Does anyone have any questions before I proceed?
Yeah, Richard, John Leahy here.
Hi, John.
Quick question. I wanted to see if you go back to the DUI chart. Your two most important charts here are the offers accepted and your DUI. And you'd said we'd gone from 12 up to 65, and I didn't quite catch how far it came back down.
It's down to about 37, I would say. And I'm just guessing reading these charts. I have clearly I have the data behind it to plot the chart, but I don't know how to plot key numbers and only key numbers. So, I'm reading that off the chart. You can see here's 60, here's 70.
Yeah, close is good. It's an interesting observation because 12 to 65 is clearly a huge change, and 65 back down to 37 is pretty significant. So yeah, thank you for that.
Yeah, and that's what the number's doing. The gray lines are your even 10. So here's your 60, here's your 70, and that's in about the middle. So I would guess 65. The number I sort of remember as I processed the data was 64 and a half. Whether I'm right on that number, it sort of makes sense based on that. Sort of the same concept here. That looks like in about the middle between 30 and 40, which I'd say is 35, but I don't think I saw a number lower than about 37.4. That may be 37.4. And the bottom numbers here are so far back, I don't remember any numbers, but you're probably about 12.
Interesting. Thank you.
You're welcome. Thanks for the question. Okay, now we're looking at is my old macro data, and I'll have to change this. This is what I'm calling blended data now. The blue line is the number of new listings in the past week, and the yellow line is the median. And the median here is the 5 years, 15 through 19. The median is dropping down because of the holiday. We already talked about why that's a week earlier or a week late this year. And you can see this week was really not impacted on this year's data. Next week, I expect the blue line to come crashing down and the yellow line to go crashing up as we're off, we're basically delayed by 1 week. This is total inventory. This is where I think my data is a lot more accurate than all the data reported by almost everybody else. My inventory is active listings on the market without an underlying contract. A lot of other sources that use MLS data include anybody that's looking for a backup offer. Those offers aren't really available in my opinion. And there's times of the year, like at the beginning of the year, January, where the number of offers seeking backups are increasing because the number of offers is dramatically increasing. The MLS inventory is increasing where my definition is decreasing, and there's actually less inventory. And that inventory really isn't available for a buyer to buy because if there's a contract, you have to get the first buyer to back out before the second buyer can come along. So that's why there's a huge difference in my data over everybody else's data. And I think mine's a much better way of doing it. Why the earth spins, everybody sees it differently. The yellow line is the 5-year median. You can see we had more inventory recently. You can see now for 2 weeks, we've been basically right on top of the number of inventory. Now, next week, we'll probably have very little new inventory come on the marketplace as the holiday, and the median will go back up a little bit. So next week, I expect to be slightly under the yellow line. Now, we're not going to be this far under like we were last year probably for quite a while. There's no way to predict the future, but we'll probably be under next week. Not dramatically, but under. Here's the number of new offers. And again, we're up. Here, I would expect the number of offers this week to be almost normal. Next week, I'm going to report on normal number of inventory. The yellow line, the 5-year median, is going to drop down. So we're going to have more offers accepted than we would expect to have accepted for that given week. Here's your heat map so you can see the areas. Just notice how much pink is back in this map. If you go back to last week, it was all white, and you can look at the DUI numbers over here. You can't average them because each area has a different number of units on the marketplace and sold, but you're going from a high of 85 to a low probably of about 26. So I'm pulling that off really quick. Yes, you got a little bit of blue, but this was pretty dark blue if I remember last week. This red right through here through the center of Santa Clara County is much redder. You can see even Milpitas, Santa Teresa. Now, Morgan Hill is actually completely white because at 43.8, it's completely white. It goes white at 42 and a half. There's at least some color there that wasn't there last week. And here, and it's a little bit off my right-hand screen. Hopefully you guys can see this last column over here. This is the current data. You started off back in May and you were bright red. So that was when everybody thought we were still in a hot seller's marketplace. And then it cooled off. You can see the colors going paler and paler and blue. And now all of a sudden, if you start paying attention on the right side, especially this week compared to 2 weeks ago. 2 weeks ago is when we were really white. There's a color here, a color here, a color right about there. Now you look at how many areas have some shade of pink to them. You got 1, 2, 3, 4, 5. I'm almost going to say 6 here for Saratoga, La Scata, 7, 8, 9, 10, and not South County. So now you have 10 micro market areas that have some shade of pink to them. That's how you can see the market starting to shift backwards. Here's DUI and the 3 different components. Here's Santa Clara County only at 40, Santa Clara County condos and townhouses basically at 40, and San Mateo County single family homes at something like 42. And this is something I need to look into, because when all 3 of my major components are above 40, the blended should not be below 40, which you're clearly spotting at. And I'm not sure why that inconsistency happens. Every time I look into it, I come up with an explanation that makes sense, but it just doesn't make sense. How is that same blended data down here now lower? The only thing I've added in is I've added in condos in San Mateo County, and that's a relatively small micro market that even if it's on fire at 10 days unsold inventory, I wouldn't think I could bring that number down. There's a little bit of a discrepancy, not huge. The micro market area data has to be the most accurate because that's the least amount of processing. Here's your overbidding. And again, this is lagging behind by 5 weeks. So this almost white data now goes with 2 weeks ago, or 1 week ago, 2 weeks ago, 2 weeks ago. And so this is going to continue to get worse for about another 2-3 weeks before it starts to most likely improve. Here is the graph over times of the 3 major components, and you can see they came way down. You can see Santa Clara County single family homes doing the worst now at under 100%. Then condos and townhouses just slightly above 100%, and San Mateo County single family homes probably about 102%. So they're way down from their peaks up here around 118%. And you can see how dramatically that came down, and that lags behind by about 5 weeks. So if you go back here, well, we know the maximum overbidding was the week of March 26th. If you go back 5 weeks from that, you're February 26th by February 19th. So right, not quite the middle of February, but the latter part of February was sort of the peak of the marketplace, and it started cooling, and it took a while for people to realize it because we don't track how many offers. It's a phrase that I sort of coined of the number of unsatisfied buyers, the buyers that went out and made an offer that didn't get their offer accepted. That number's not tracked anywhere, and that would be the best number to have. That would be more leading indicator than DUI, because DUI, if you have 20 unsatisfied buyers, your DUI is the same as if you have 2 unsatisfied buyers. It's only after you start getting 100% of your satisfied buyers that your DUI starts impacting. But we don't report that number accurately, unfortunately. We don't report it anywhere, and we don't report it accurately because we don't report it. And if we did report it, it probably wouldn't be accurate because the only person that has that information would be the listing agent. Here's your magnitude of overbidding, and this is, again, should be blended data. You can see blended everything together, you're just over 100%. It was like 100.3% or something of that order. This is the frequency of overbidding. This is second to magnitude, because someone that was pulling 18% over in February is willing to pay 1% over now, is still willing to overbid. In a couple more weeks, if the market continued to deteriorate and it looks like it's improving, they might not be willing to overpay. So the frequency of overbidding is more stable than the magnitude, and that's why it's second in my reporting. Here you go blue, anything below 33%. So 33% to 50% even is what I call the white marketplace or balanced marketplace. Above 50, you start going pink. Again, this is lagging data. This is going to be lagging more than the magnitude, so I'd pay attention to magnitude more than this. But again, the same thing. You can see up here, Santa Clara County, 92% of your sellers of single family homes in Santa Clara County were getting more than their asking price. And now you're somewhere down around 39%. Dramatically different, a very steep drop off. These numbers now, it appears after about 3 more weeks of going down, will turn around, level off, and turn around and come back up again. This is the frequency blended. You're sitting here at 45. You can see it actually peaked down at 35% for 1 week. That almost looks like a bad data point to me, but I'm not aware of any bad data. Here is the sale price. The middle number is the median for the micro market area. The number to the left is the cheapest 10 percentile. The number to the right is the highest 90 percentile, the most expensive 10%. Here's the median price in the red for single family homes, Santa Clara County, median price for condos in Santa Clara County, and median price for San Mateo County single family homes. You can see they all roll down. You can come back here and in San Mateo County, you can see how we're close to 2020 pricing at the low point, even in October pricing. And you could come back here to early 2021, April 2021, and you're a little bit below that. Sort of the same thing with Santa Clara County. You come across and it's hard to say because you were pretty flat here, but you start getting way back here to like April of 2021 and you're back to those same prices. And then again, you can do the same thing with condos and townhouses in Santa Clara County. Draw back to the horizontal line, you're coming back. Condos are a little bit more stable. And, I might say that they only are like July of 2021. You come back here to April of 2021, and it appears to me to be quite a little bit lower. This is just the overall appreciation in each micro market area. We now have two that are negative. And again, I do this a little differently than most people, and I almost changed it, and now I'm glad I didn't. I'm using the entire 2020 calendar year as my median. So I'm not comparing year over year. I'm comparing a whole year. And the reason I'm doing that is now you have a rock solid base, and the changes that you're seeing here are the change based on a 5-week moving number from week to week. Santa Clara County didn't change from last week to this week, but from August 13th to August 20th, it dropped from 22.6% appreciation to 16.8%. Those are pretty significant numbers. From week to week, it really doesn't matter. But if you go over to the right-hand column, these are the maximums. This is Foster City, up 64% from 2020 pricing, and now it's down at 1%. Someone that bought in the peak price for 164% at the peak of the marketplace, their home now would be worth 101%. So they've lost 63%, and you were at 1.5 times that. So you have to divide the 63 by 1.5. So they've lost about 40% of their peak value. All these bases are based on 2020. Whether you're going up or down, you normally take the high number as your base. If you look at these numbers, here's your median price for 2020, so you can see what the median is. And now if you multiply that by 118%, the 890, you'll get to the current number. The data is all accurate. It's all there. It's shocking. You look at some of these numbers, 3.9% for the San Mateo County coast. It was up to 40%. You take Saratoga, Las Gatos, it was 57. And it was actually 57% I think this is May 28th up here. Just at the end of May, Saratoga, Las Gatos was at 57.7% above their 2020 pricing, and now it's only 16% above. Those are pretty significant drops. This gives you a recap of the different micro market areas. So you can see the DUI in the micro market area. You can see the magnitude of overbidding, the frequency of overbidding. Again, these two columns lag behind by 5 weeks, at least the magnitude. Frequency, I would say it lags by 5 weeks, but it's also a more stable indicator. So it actually lags by even more. And then when you jump over to price, that has nothing to do with market conditions. It's simply to do with price. Blue is whether it's below the median price, and red is whether it's above the median price. On condos, white is the median, and then you go blue below the median. Here are some of the components. Look at this. This sort of caught me off guard. Santa Clara County only has 80% of the inventory you'd expect it to be, down from 88% last week. As far as the inventory that we'd expect, we only have 80% of that, which would put us in a seller's marketplace. San Mateo County single family has 120%. Condos in Santa Clara County, 106%. Here's your DUI, 38.7% for Santa Clara County, 45.5% for San Mateo County, 39% for Santa Clara County condos, and 64% or 64 days of unsold inventory for Bay condos. Going on to overbidding, you can see the numbers for yourselves, right around 100%. Frequency of overbidding ranging from 40% to 50% in rough numbers. Here's the appreciation for the county micro market areas. In San Mateo County, I use just the Bay cities because that's where the most of the condos are, in the Bay cities. Here you can see the peak appreciation for 2020 and the peak appreciation for 2021. So you can see we went up 25% basically in 2021. We went up 20% in 2022. And now overall, we're only up 16%. So you can see we're below San Mateo County. We're at 7%. So they're almost back to where they were were in 2020. Now we're going to change to single family homes in Santa Clara County only. And that's because I have 20 years reference. Here you can see DUI was down here. So we can get the number pretty accurate. Here's 20, here's 10. So you're probably at like 15. You went all the way up to 60, and now you're down just below 40. The round line in the middle, the black line in the middle is the median. So this is where you'd expect data to be. The red line is the low year we had, and the blue line up here is last year. So we went from the best year we ever had, better than the best year we ever had, to worse than the worst year we ever had. And now we're between the median and the best year we've ever had. It's clearly been a huge shift. And this again is single family homes, Santa Clara County, 5-year median being 15 through 19. This is looking at the delta. This is where I take the DUI, I subtract off the expected DUI and plot it. So if you're having a completely normal year, you'd be at 100%. You were having better than a normal year, way worse than a normal year. And again, since about the middle of August, you've been having a slightly better than expected year. Here's the average. So this is the 7-day average of the delta. So I take that delta, plot it out, and average it over 7 days. And that's to get rid of spikes like this. This spike here is probably a bad data point that's got to get my attention. But you can see you've come down, and now you're below where you'd expect the data to be. Here is the data in a table form. It's going back for 20 years. It's not complete apples and apples because this is reporting August data so that we're not looking in the rearview mirror. So normally this is data acquired on September the 5th. We're only to August the 27th. This is data that was acquired today. You can see that it's the closest data point you have if you only have monthly data going back. But DUI at 38.7, you can see that that's respectable. It's better than a lot of the years. There's clearly better years, 22, 26, 18, but there's also worse years at 52, similar years 44, 40, 40, 41. I don't know why those went to zero. Clearly a processing error, 49, and then you get back to the slowdown, 125, 210. Those were the mortgage meltdowns for those that have been in the business a long time. And for those that like to look at apples and apples comparison, you got to look in the rearview mirror because we're not to September 5th yet. So this is now looking back July data collected on August the 5th. I think it's pretty irrelevant. And with that, we should be done. So I'm open for any questions. Not hearing anybody. Have a great week, everybody.
Thanks, Richard. Great presentation.
Thanks, John. Take care of yourself.
You too. Have a good weekend.
Bye-bye.